Hey everyone, welcome back to Stock Talk. This one's titled, When Good Isn't Good Enough. So, for years, investors have been told that strong earnings are all that matters. This earnings season reminds us that in the stock market, strong results alone aren't often enough. Stocks react not to earnings themselves, but to how those earnings compare to expectations already embedded in the stock market. There are 4 key takeaways this quarter. Earnings season was outstanding, but several stocks fell. Investors didn't reward good results. They were only rewarded with results that exceeded the very highest or those who jumped over a very low bar and low expectations. Second, profit margins remain near record territory. Companies continue to demonstrate pricing power and operating leverage despite higher interest rates and ongoing economic uncertainty caused by the Iran war. Third, technology, energy, and materials are driving earnings growth. The healthcare sector remains the major laggard as earnings estimates continue moving lower in that group. Finally, overall, S&P 500 earnings outlook is accelerating. It's not slowing. FactSet now expects more than 20% earnings growth for the S&P 500 in both the second and third quarters, and then even in the fourth quarter of this year. So, everyone, I'm glad you've joined us. This week, I want to discuss a lesson that every investor eventually learns. Sometimes good isn't always good enough. In fact, some of the biggest stock declines this earnings season occurred in companies reporting results that most investors would consider excellent. Why? Because short-term stocks don't always move based on whether earnings are good or bad. Many times over shorter-term earnings periods, stocks move based on whether earnings are better or worse than the marginal buyer or seller stock expectations. And right now, expectations, especially for artificial intelligence, semiconductors, and technology companies, that expectations bar has become extraordinarily high. The latest FactSet Earnings Insight Report from June 6 offers a useful big picture snapshot of the current earnings environment. The outlook for the overall market in the S&P 500 earnings remains very strong over the next few quarters. Even so, several market favorites sold off after reporting first quarter 2026 results. Today, let's look at what happened and what it might mean for investors going forward. So, first point, S&P 500 earnings scorecard. Let's go ahead and look there. Fundamentals remain very, very strong. Let's start with the good news. The overall earnings season remains exceptionally healthy. FactSet reports that most companies beat both earnings and revenue estimates in the first quarter, and analysts have actually raised earnings estimates throughout the quarter. This is very unusual overall. This almost never happened. Historically, analysts reduce estimates by roughly 2% during a quarter. So far, not this quarter. The second quarter bottoms up earnings estimates have increased by 2.7% since the end of the first quarter, March 31st. That's a swing of nearly 5 percentage points relative to history. Even better, companies themselves are optimistic. Of the 108 companies issuing guidance for the second quarter, 61 issued positive guidance, 47 issued negative guidance. That means 56% of companies guided higher compared to an average of only 41%. So right now, FactSet projects second quarter earnings growth 21.7%, third quarter earnings growth 25.1%, and fourth quarter 22.6%. For the full year of 2026, that's earnings growth of 22.8%. If that's achieved, second quarter would mark a second consecutive quarter of above 20% earnings growth, 7th consecutive quarter above double-digit earnings growth. Those are remarkably strong numbers. Yet despite all the good news, investors still punish several companies. Why? Because expectations were even higher, and many stocks had already rallied 30 to 100% off the late March lows. Remember, the S&P 500 rallied over 20% in less than 45 trading days. That's a true V-bottom. It's also why we called this when good results weren't good enough. What are we talking about? Consider several recent examples. Here's a quick table. Look at that list. You know most of the names. They all reported better than expected numbers for the most part, and most of the stocks actually declined. Most of these companies continue to benefit from strong underlying business trends, yet investors have become increasingly selective. After enormous stock gains over the past years, even strong earnings are being scrutinized for signs of slowing momentum, lower future growth rates, or any indication that expectations have gotten ahead of reality. This is the classic late-stage bull market behavior. The lesson? Over the short term, stocks often don't get rewarded for being great. They get rewarded for being greater than expected. Second point, Profit margins remain very, very good, better than expected overall. That's the second takeaway from the earnings season. For years, investors have worried that inflation, higher wages, and higher interest rates would crush corporate profitability. That simply has not happened. Instead, many companies have adapted remarkably well. Profit margins remain near historically strong and high levels. Many companies continue to use technology, automation, artificial intelligence, scale advantages to protect profitability. This is one reason earnings growth has been accelerating faster than many economists and strategists expected. A company does not need explosive revenue growth if they can improve efficiency and expand margins. And that's exactly what we're seeing across a large part of corporate America. The margin story is one of the most underappreciated bullish developments in the overall market. Point 3, winners and losers by sector. Yep, a lot of times sector matters. The leadership sector remains very clear. The positive contributors, information technology, while the energy sector has grown the fastest by market cap, technology continues to dominate earnings growth. When the S&P 500 has 50% technology stocks at the top, it's hard not to look there. FactSet estimates that second quarter earnings growth for the sector at over 58%. Single stock-wise, NVIDIA and Apple have been among the largest contributors to higher expectations in that group. In the energy sector, energy has experienced the largest upward revision. Expected earnings estimates have increased nearly 50% since March. Chevron, Exxon, ConocoPhillips, and other producers have benefited from stronger commodity trends. Third group, materials. Materials rank third in upward revisions. Chemical and industrial materials companies have seen meaningful estimate increases as economic activity remains stronger than expected. On the negative side, you got to look at healthcare. Healthcare is the lone weak spot. Expected earnings have fallen sharply since March. FactSet now projects earnings contraction for the sector, driven largely by estimate reductions at companies like Gilead Sciences. The contrast is striking. Technology, energy, and materials are moving higher. Healthcare estimates moving lower. That divergence is helping explain much of the market's leadership we've witnessed the last year, and especially off the March lows. Fourth and final point, the outlook is getting better, not worse for the overall market. Perhaps that's the most important message in this entire report. Analysts are becoming more optimistic, not less. Here's a graphic for 2026 and 2027 S&P 500 bottoms up earnings estimates. $336 in earnings in 2026 and over $390 in 2027. Even FactSet's quarterly bottom up earnings forecasts continue to move higher. Current expectations call for earnings growth in the second quarter, 21.7, third quarter, 25.1, fourth quarter, 22.6, full year, 22.8. Revenue growth also remains strong. Second quarter, 12% growth. Third quarter, 10.7% growth. And fourth quarter, around 10.2%. Those aren't recession numbers. Those are expansion numbers. The challenge for investors seems to be we've run quite far and fast off the March lows in valuation. The S&P 500 forward PE multiple now stands at 21.1 times earnings. That's above both the 5-year and 10-year average. That means that the market is already pricing in some good news. It's also why the gains year to date have been entirely earnings growth, while PE multiple expansion is actually not expanded, it's contracted. And that's what we're seeing. Some stocks decline after a strong earnings report. Expectations have risen almost as fast as earnings. So everyone out there, what's the bottom line? The latest FactSet report paints a very encouraging picture for the overall stock market. Corporate earnings are growing and actually projected to accelerate for at least 2 more quarters. Profit margins remain strong. Guidance is improving, and analysts are raising estimates. And earnings growth is expected to remain above 20% for the rest of this year. That's the good news. The challenge is that many investors already know it. And in today's market, simply being good isn't good enough. Companies must exceed expectations. They must raise guidance. They need to demonstrate an acceleration in their business. When valuations are elevated and optimism is abundant, the market demands near perfection. That's why the theme of this earnings season is simply, when good isn't good enough. I'm Chris Paris, and thank you for watching, and I'll see you again next week.